Hey, it's Peter here from How to Invest HQ with June's update for the How to Invest HQ portfolio. And if you're not familiar with the portfolio, it's a small stock portfolio. It's completely free to view and it's publicly available on my website. And the purpose of the portfolio is to add around $1,000 a month and invest in about 5 stocks and then continue to add to those positions over time. And the purpose of this portfolio is just to show home-based investors how not only to pick stocks, but also how to add to their positions over time. And I provide monthly, quarterly, and annual updates. All moves made by me are publicized right on my blog as soon as they happen. And while this is an investing portfolio, note that it isn't a long-term strategy and there is risk involved, so follow at your own risk. So for June, I ended up purchasing 2 shares of Google, and I ended up purchasing the GOOGL version. And my main motivation there over just the GOOG is that I own shares of GOOG for my personal positions and just want to keep them separate for the portfolio. So if you want to save a couple bucks and don't care about voting rights, go ahead and buy GOOG instead of the L version. I purchased 2 shares at $568 a share. And while the stock was up over 9% in the last month, it's still flat year to date and down 6% in the last 3 months. So there's definitely room for Google to move, but I'm not buying Google for a short-term gain. I really just wanted to get a position active that I can add to over time as part of the portfolio. And why Google? Google's a company I really like. I've liked them for a long time. I wrote a post a few months ago about why I think that Google might be the first trillion-dollar company. Google's real value is not really its search engine, its mobile operating system. It's not Android. It has nothing to do with any of its products. What Google's real value is its extensive internet ad network and big data aggregation. Google is by far the #1 player in internet advertising. If you want to advertise on the internet, you pretty much have to go through Google. The only other option to reach a large audience is Facebook, and it's just not nearly as targeted or diverse as Google Ads. And why is Google's ad network so big? It's because they have so many different channels with which you can advertise. They're an order of magnitude larger than Facebook when you consider the reach of their ad network. They had definitely by far have the biggest source of targeted advertising via their search engines. Someone types in lawyer San Antonio, they're looking for a lawyer in San Antonio. So if you're a lawyer in San Antonio, you can advertise for those positions. Facebook really can't give that kind of direct advertising, nor can Twitter. Nobody can. I guess the market that would come as close would be LinkedIn, because theoretically you could advertise to particular professionals that might be in a position to buy your business-to-business service. But for business-to-consumer marketing, nobody beats Google. That's just the way it is. They have the best targeted ads, but that's only a fraction of the size of their ad network. If you want to advertise on third-party websites through display advertising, that's banner ads, getting a message out there to a large number of page views, or even the same sort of click-based ads on relevant websites. Google's AdSense platform is by far the largest format for doing this type of display advertising. My website myself, How to Invest HQ, has AdSense ads on it, and people who offer services related to investing in the stock market, financial services companies, can buy ads through Google that will then show on my site and many sites like mine. Facebook doesn't have that. No other network. There's other competitors to Google, but no other network has the reach Google does. And they do it because they don't take too much of the profits, so it's very lucrative for me to want to put AdSense ads on. I get to keep the majority of what advertisers spend, and their algorithm is really good at matching ads to users. It's much better than any other network, and as a result, it makes both Google and the website owner the most money, and advertisers are happy because they can reach more people. And consumers end up clicking on the ads more because they're relevant. They're not oddball ads. They're actually something that might be interesting to a person reading an article on my website. And finally, Google also has by far the largest video advertising channel, thanks to YouTube. If you're watching this video, you probably saw an ad in the beginning via YouTube that somebody's paying for, and Google's taking a share of that revenue. And they also just bought Twitch, which is a gaming-based video streaming service. It's very popular as well. So between those two, if you want display or video advertising, you have YouTube, and as a result, Google is the place to do it. And just a quick note on Google, the reason that this is so important is that I missed that on the last slide, is that internet advertising market, it should say market size rather than set, the internet advertising market is set to grow by double-digit percentages year over year for the foreseeable future. So basically every media statistics company is saying that they expect advertisers to increase the total budget for internet advertising by double-digit percentages for the next 5 years. So the market's set to grow by about 15% per year. So if Google just maintains its current status, its revenue is going to grow by 15% just because more people are advertising on the internet. And I think that they can do more than maintain, because that every year so far they're gaining additional users and coming up with new services. So Google's revenue is going to continue to grow just by default because they're in the internet advertising market, and that's a growing market. So here's an update on how previous positions did over the May period. LinkedIn had a nice month; it was up over 4%. And Potbelly, that's definitely got to be my worst investment. I'm starting to think that was, or not. I'm not starting to think. I do think that I misjudged the value of Potbelly when I bought in. I think that the share price definitely was hurt more than expected due to unseasonable weather. I couldn't really have predicted that, but I could have come in at a better price. I think that they were overpriced, and I think the only reason I settled on Potbelly was because I wanted a fast casual food stock because I like that space, and my number one pick was Chipotle, and I thought that Chipotle was too expensive, and it was, because at the time it was about $600 a share. It came down to about $490 a share, and I guess the lesson there is that don't settle for the second, your second pick stock because the one you like is too expensive. Just wait until the one you like is a better price, or buy in and average down. So I think that at current prices, Potbelly is finally fairly priced. And I was really worried about Potbelly last month because Chipotle had come down so much. But Chipotle's really rallied since then. It's up over 10% in the last month. It makes Potbelly more attractive, Potbelly and Chipotle now have similar forward PEs. Chipotle might even be a little bit higher. So it makes Potbelly a much smaller company, as can more easily just expand by opening new locations, whereas Chipotle can still open many new locations, but it's got less room to work with given its current valuation. I still like Chipotle though. I'm not saying don't buy Chipotle, and I still might buy it in the future if it's at a reasonable price. So Zillow, that had a big jump this month, another 8.5%, and that's on fire right now. I just wrote a post on my blog if you're curious about my feelings on Zillow. I really do like Zillow currently. I'm still holding. Their traffic is just doing really great according to internet metric sites. So I think that they've got a chance to revise guidance upward. They are very expensive right now, but I think that they could still surprise to the upside. If they do move higher, I could see myself selling out just because they're at a very high valuation, but I think they have to move up higher for me to want to take, try and take profits here. Amazon had a nice little gain in May, and they've moved up a lot this month on news of a new phone. I still think Amazon is cheap. Probably out of this sheet right now, LinkedIn and Amazon are the best buys. I still think Amazon's a good buy. I may add more at the end of this month, so that's still in the realm of possibility. So overall, we had a nice gain in May, even in spite of Potbelly doing so poorly, still beat the S&P average for May. Since the beginning of the year when I started this portfolio, we're still down a little bit over 3%, and S&P is up a couple percent this year, so not great, but it could be worse. We're definitely improving now that we are having more positions to be involved in. Potbelly really killed the portfolio off when it was just, holding two different companies or three different companies. LinkedIn's drop definitely hurt as well. But I see LinkedIn moving out of its current low price sooner than Potbelly. Potbelly might take a while to grow into, its my original price per share. But I think now that I'm more diverse, I think that we're going to start seeing good gains through the rest of the year. I think that I'm, well diversified now, and I'll finally be able to just add just current positions. I may look to pick up one more stock. I may eventually replace Potbelly and sell out of that entirely and pick a different fast casual stock, especially if I can get Chipotle at the right price. So that's it for this month. Go ahead and subscribe to my channel for more updates to the portfolio. Follow my blog, and I'll be posting another update as well as a quarterly update at the beginning of July.